Good evening, everybody, and Assalamu alaikum, and welcome to all of you at the ACCA Prepare to Pass session of paper P2. So I just wanted to check that whether you people can hear my voice. Please write yes in the chat box if you can hear me. If you can hear me, please write yes in the chat box. Okay, that's fine. Okay, so let's start. So how many of you have attempted the home assignment of day 1, day 2, and day 3? I have given you 3 questions of consolidation and 3 questions from the past paper relating to IFRSs. So how many of you have attempted? So please write yes in the chat box if you have attempted. Okay. How many of you have attempted the home assignment of all the days? If you really wanted to pass the exams in this attempt. So it's very important that you should have to do a lot of practice, and I think 3 questions in 3 days is not a big task, in which we have already discussed all the provisions. And what about the question number 2 of day 1, day 2, and day 3 relating to IFRS? So it's good for you. Do remember this. It will be good for you if you are attempted it on a regular basis, because the lack of practice is one of the reasons for the failure of the students in the examination. Okay, and also I have shared 2 summaries of the relevant IFRS on the WhatsApp group. Do you people have received the summaries of IFRS 9 and IFRS 2? Yes, some of the students not yet. Okay, I have shared them out. I have shared it on the WhatsApp group. Please received the summaries and try to study from that. And if you find these summaries easy to understand for you, it's actually a mind map type of summaries. So if you think that these summaries are good for you, so you can tell me about whatever standard you want from me. Just message me and I will send you the summary of the rest of the standards. So did you find the summaries useful of IFRS 9 and IFRS 2? Okay, that's fine. Need all the standards. Okay. So today we are going to start and discuss some of the tools and some of the standards which are important for this attempt. And at the same time, the management of the ACCA will send you the mock exam today. So it's my request for all of you to please do attempt the mock exam by Friday, so that we can discuss the answers and the basic exam techniques at how to solve the paper on Saturday. So on Saturday, we'll be having 2 hours for the mock debrief session, and in the remaining 1 hour, if you want any support in any IFRS, then we can discuss and utilize the 1 extra hour on Saturday. So if you want any type of support in any IFRS, we can have a discussion on that IFRS on Saturday. How do I, can I have the link of the WhatsApp? Okay. Okay, so let's start. Today we are going to discuss IFRS 15, which is one of the, I think, which is one of the important standard for this session. So here is a summarized diagram for you. From this diagram, you can easily understand and memorize the basic principles of IFRS 15. So let's start. IFRS 15 is actually the standard with the name revenue, which was previously in IS 18, and we'll be having IS 11. The IS 11 is relating to construction contracts, and IS 18 is relating to the revenue. But IFRS 15 overrides and supersedes both IS 11 and IFRS 15 and some of the IFRICs and SICs. So the most important feature of IFRS 15 is that the IFRS 15 is based on principle-based approach rather than rule-based approach. So the name of this standard is revenue from contracts with customers. So IFRS 15 is one of the standard which is actually the outcome of the Norwalk agreement between the FASB and IASB. So as you all know that there is a convergence project of US GAAP and IFRS, and IFRS 15 is one of the output or outcome of this convergence project, which is called Norwalk agreement. So according to them, there must be a principle-based approach for all the IFRSs. Therefore, they are updating their relevant IFRSs, and we have seen IFRS 15, and they are actually removing the. So what they have done for all the contracts, either it could be a construction contract or either it be any type of contract for the goods and services, you have to apply IFRS 15, which is having a 5-step approach that we use to recognize the revenue. So starting from the track, this is actually a jogging track for all of you. So starting from this track, we are here right now, and we are moving, and the first step is here. So here we have step 1. For all the contracts, first of all, you have to identify the contract. Identify the contract means identify the parties involved in the contract, whether it is probable that the party will get the benefit from this contract, whether there is an oral or written contract, what are the terms of the contract. So you have to analyze whether there is a contract exist or not. So if there is a contract between the two parties, then the first step is done. Then we are moving towards the second step. Then we are here on this track. Then when we have identified the contract, the second step is to identify the performance obligation. Then we have to identify the performance obligation. The performance obligation means that what are the responsibilities of the supplier or the party who is recognizing the revenue, what are their obligations to deliver against some consideration. So sometimes there might be goods, there might be services in the same transaction. So the transaction which involves goods and services is actually called bundle transaction. So you have to identify what are the obligations within the contract. So it might be possible like the company is selling cell phones along with the services of calling for 1 year or 2 year or 3 year, and the company is charging just a lump sum amount for both the goods and services. So you have to recognize that this contract according to the provisions of IFRS 15. So second step is you have to identify the performance obligation within the contract. So it might be an institute who is selling the goods and the services of paper P2, that the tutor will teach you the P2 for the whole 6 months or 3 months, and the institute is selling you the book also at the same time. So the price that they charge with the customer includes the price of the goods and the services. So it might be the company is selling its cars with the services contract or maintenance contract for 2 to 3 years. So this contract will include the goods and the services. So you have to identify what are the performance obligations embedded in the contract. So the first step is to identify the contract. The second step is to identify the performance obligation. Then we are moving towards the third step. Then we have determination of the transaction price. So what should be the transaction price for this contract, that we are selling the goods or we are selling the services or we are selling the both at the same time. So what should be the ideal transaction price? So you have to estimate the transaction price according to the provisions of IFRS 15. Then you have to allocate the transaction price on the separate performance obligation. Suppose I'm selling a car with a maintenance contract for the 3 years at a value of $60,000. So I'm selling the car, and at the same time I'm giving you 3 years maintenance contract. So the company will provide free of cost the maintenance service to its customers. So I'm selling the goods and 3 years service at the same time. It is actually called the bundle transaction. So for that you have to allocate the transaction price, that what should be the price for the car and what should be the price for the maintenance contract. So this is one of the requirement of IFRS 15, to allocate your transaction price between the goods and the services. So starting from the first step again, then you have to identify the contract with the customer first. Then you have to identify the performance obligation, second one. Then we have to determine the transaction price, and then finally we have to allocate the transaction price to the individual performance obligations. And finally you have to recognize the revenue when the performance obligation is satisfied. So your work is done, therefore this person is actually in a relaxing mode. So he is taking a sun bath because of the fact that he has recognized the revenue, and now he is relaxed. So you have to recognize the revenue for the goods at the point of the time, and for the services it should be over the period of time. So the revenue from the goods will be recognized and earned immediately when we transfer the risk and rewards of the goods, but the revenue from the services will be dependent on the stage of the completion or the level of the service that we have delivered to the customer. So if you have delivered 30% service, so you can recognize 30% revenue, and the excess amount that we have received for the service will be considered as unearned revenue or unearned income, which will be called, which you can say that the unearned income or unearned revenue or deferred income. So it is actually the liability of the business if you have received the amount in advance and you have not yet delivered the service. So these are the 5-step approach for IFRS 15. Identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price, and recognize when the revenue of the performance obligation is satisfied. So now we are moving towards the second slide. Now again we have the 5-step in a more simple manner. Then first of all we have to identify the contract. Then we have to identify the performance obligation. For example, we have to deliver 2 performance obligations. One is for PO1, the second one is PO2. Then we have to identify the transaction price. Then we have to allocate the transaction price to PO1 and PO2 separately. So how we can allocate the transaction price? So you have to wait for 1 minute further. So we will discuss all the provision in more detail. And then finally, recognize the revenue when the performance obligation of PO1 and PO2 is satisfied. So this is again a diagram for you that you can use for the memorization of the provisions of IFRS 15. So just for this, by looking at this diagram in a single site, you will have the idea of the basic provisions of IFRS 15. Now, so let's start. The first point is identify the contract with the customer. So what are the points that we should have to consider when we are identify the contract with the customers? The first point is that the contracts must be approved by all the parties. So if you have studied paper F4, like there should be a proper valid offer and acceptance for the contract. So in the same manner, when we have to recognize a contract with the customer, we should have to understand this, that the contract must be approved by both the supplier and the customers. There must be a proper valid offer and valid acceptance. Then in a contract, everyone's right can be identified. What are the rights of the customers and what are the rights of the supplier? What the supplier have to do in the contract and what are the requirements of the customer. The payment terms to be identified, whether it will be on a cash basis or the customers should have to pay the amount in advance or in arrears, or whether the time period is 60 days or 30 days, whatever be the terms of the payment, it should have to be identified first. Then it must have a commercial substance. Commercial substance means the cost and the revenue of the contract. So the cost and the revenue should be more than the cost of the from the cost of the contract. So you can say that this contract has a commercial substance. And finally, the consideration will probably be paid. So there is a probable chances that the supplier will get the benefit in the future. It might be possible that the customer will default in the future, but at the initial stage, it is probable, it must be probable that the supplier will pay the amount. So the consideration will be probably be paid. So these are some points which is used to identify the contract with the customers. So it is highly recommended to try to memorize these points. So you can memorize these points by writing the provisions on a daily basis, the key provisions of the daily basis. So let's moving on towards the next slide. Okay, then secondly, we have to identify the separate performance obligation in the contract. This will be goods or services promised to the customer. Like I'm selling the car with a maintenance contract. I'm selling the book with tuition, or I'm selling any type of goods with services. These goods and services needs to be distinct and creates a separately identifiable obligation. Distinct means then the transaction of this goods or services can take place alone, or it's not compulsory that these are attached with each other. Like I can sell my car separately and I can deliver the service and sell the services separately. So the goods and the services should be distinct and create a separate identifiable obligation. Distinct means the customer can benefit from the goods slash services on own, and the promise to give the goods and services separately identifiable from other promises. Separately identifiable means no significant integrating of the goods and services with other promises in the contract. The goods and services does not significantly modify another goods and service promised in the contract. The goods and services is not highly related, dependent on other goods and services promised in the contract. So these are some of the points that you should have to use for the identification of the separate performance obligation. Then moving forward, determine the transaction price. The transaction price is how much the entity expects considering the past customary business practice, how much that you are normally charging for these type of goods and services will be considered. Some variable consideration attached in the contract. It might be some refunds, it might be some rebates, discounts, bonuses, contingent considerations, etc. However, the variable consideration is only included if it is highly probable. This is the most important point for this slide. The variable consideration is only included if it is highly probable that there won't need to be significant revenue reversals. So if we are including and recognizing the revenue with some variable considerations which will not occur in the future, then we have to reverse the revenue. So in a very simple terms, IFRS 15 is saying that you are not required or you are not allowed to overstate your revenue. But if it is probable that you will not going to reverse whatever consideration you are adding in the revenue, then you can recognize the variable considerations. But if it is probable that there won't need to be a significant reversal in the revenues, then you cannot recognize it. So IFRS 15 says that variable consideration is only included if it is highly probable there would not need to be significant reversal. So if there is a chances that the revenue will have to be reversed in the future, then you are not allowed to include the variable consideration. However, for the royalties from the licensing intellectual property, recognize only when the usage occurs. So what does the variable consideration means? We are just discussing the basic provision, then we'll take the example of each and every area. So you have to wait for a few minutes to understand the basic principles. But the variable consideration means that you are charging more amount or giving some discounts or refunds or having some bonuses to the customers. These are called variable considerations. Next, allocate transaction price to the separate performance obligation. This is again one of the most important point. If there is a multiple performance obligation, split the transaction price by using the standalone selling price. This is again a most important point for this standard. So you have to break the transaction price between transaction price, performance obligation 1 and performance obligation 2. So how we can distribute the transaction price? So standard says that you have to use the transaction price by using the standalone selling price. So at what amount we are normally selling performance obligation 1 in the market, for example, for 100. And for what amount we are selling the performance obligation to in the market, for example, it is 50. For example, you have to move back. Yes. For example, the price for this is 200. So the total price of P1 and P2 is 300. So the weightage of P1 is 100 upon 300 and the weightage of the P2 is 200 upon 300. So we have to calculate the percentage and the weighted average according to standalone selling price. And then we multiply this value with the transaction price. So assuming that we are selling both P1 and P2 in a discounted price of 250. So what is the price of P1 and what is the price of P2? So it depends upon the weightage of P1 and P2 according to the standalone selling prices. So how to estimate the selling price? Adjust the market assessment approach. It could be an adjusted market assessment approach. It is like you have taken the price of the similar goods and adjust the price according to the requirements of your product. Second one is expected cost plus margin approach. The cost that you are incurred and the cost that you have incurred already, and by adding your profit margin, you got the selling price. The residual approach only permissible in a limited circumstances, like the residual approach means that at what amount you have to sell it if the market of the product is not up to the mark and you are selling it at an enforceable saleable value. So this is called the residual approach actually. If paid in advance, the discount down if it's significant, it's more than 12 months. If paid in advance, discount down if it's significant. So it's again a very important point. Like you have received some of the amount in advance and some in after 4 years. So if you have received some of the amount in advance and some after 4 years, then you have to use the present value of the future cash flows. So we'll be discussing these provisions in more detail in the next slide. Okay. This is again one of the most important point. Recognize revenue when or as the entity satisfies the performance obligation. So when we have sold the goods or when we have delivered the service, the performance obligation criteria got met and we can recognize the revenue. The revenue is recognized as the control is passed over time or at point of time. So when there is a transfer of the control, what is control? It is the ability to direct the use of and get almost all of the benefits from the asset. So when we actually, in a very simple term, you can say when the risk and rewards of the goods has been transferred from the seller to the buyer, then you can recognize the revenue. This includes the ability to prevent others from directing the use and obtaining the benefit from the asset. The benefits could be direct or indirect cash flows, using the asset to enhance the value of other assets, pledging the assets to secure the loan, holding the asset. So remember, we recognize revenue as an asset control is passed, obligation satisfied to the customer. This could be over time or at a specific point in time. So a specific point in time is used for the goods and over time will be used for the services. Can you solve one past exam about IFRS 15? Yes, we have to discuss some of the, and we'll discuss some of the past paper questions. I'm just giving you, first I'm giving you the flavor of the provisions of IFRS 15. Then we'll be having some questions, simple question, then we'll be having some past paper questions. Example of the factors to be considered of a specific point in time. Sorry. The entity now has present rights to receive the payment of the asset. The customer has the legal title of the asset. The entity has transferred physical possession of the asset. The customer has significant risk and rewards of the ownership. The customer has accepted the asset. So these are the points that tells you that the controls of the goods has been passed from the seller to the buyer. So let's have a short question. Johnny enters into a 12 months telecom plan with the local mobile operator. So the contract is within the period of 12 months. So there is no need to discount the contract. The Johnny monthly fixed fee is 100 currency unit. Johnny received free handset at the inception of the plan. ABC sells the same handset for 300 and the same monthly prepayment plan without handset is 80 per month. So what actually Johnny is getting for this 100? So Johnny is getting handset and services both at the value of 100 per month, and the goods, or you can say the value of the handset, in the standalone contract is 300. Like individually, if you go and purchase a particular handset of this quality, you have to pay 300. And if you are going to purchase this type of service which the Johnny is receiving, so you will get the service at 80 per month. 80 into 12. So 12 into 80, the value will be 12 into 80, 960. 100 into 12 will be 1200. So the price of the goods and the services collectively will become 300 plus 960. That will be 1260. And Johnny is receiving this at a value of 1200. So the fixed fee and the transaction price that the Johnny is paying is 1200, but the value of the goods and the services will be, in total, that will be 1260. So my question is that what will be the value of the goods and services from this 1200? So all of you are required to allocate the transaction price. So please tell me. This is actually called the bundle transaction. So there's a question from the student side about how we allocate the transaction price on the bundle of the goods. So the answer is you have to calculate the price of the individual item separately, and you have to take the weighted average and multiplying the percentage with the total amount that we have charged in a bundle transaction. So suppose if the handset cost percentage in the total value is 50%, so the 50% of this 1200 will be considered as a value of the goods and value of the service. So if the control has passed, you are very right. One of the student has calculated the value. Handset for 286. There is a highly probability that the customer will not pay. Can we still recognize revenue? There's a question that if the control has passed to the customer, but there is highly probability that the customer will not pay, can we still recognize the revenue? So the answer is, if the control is passed, and at the time when we are recognizing the revenue, it is highly probable that the customer is not going to pay the amount, then you cannot recognize the revenue. But if at that time when you are giving the control of the asset to another party, to the customer, and at that time it was probable that you will get the answer, you will get the amount, so you can recognize the revenue, and subsequently this amount will be bad debt if the intention of the customer has changed. But if at the initial stage it is not probable, it is highly probable the customer will not going to pay you, then you cannot recognize the revenue. 79 for the goods and 21 for the service. Okay, I think someone has calculated the amount on a monthly basis. So for annual basis, 300 divided by 1260, you got the value of 24% into 1200. The amount will be, I think it's, I think I have done something wrong. 300 divided by 1260 multiplied by 1200. The value of the goods is 288. And the value of the services will be 1200 minus 288. The amount will be 912. It's 912. Am I doing something wrong? 18 to 12. It's 960 plus 300. So 300 divided by 960, 1260. The value will be 24 into 1200. It's 288 actually. Okay, it's a rounding error. So 288 and 912. This is how we can break and allocate the transaction price. Okay. Actually, Johnny, monthly fixed fee is $100. So 100 into 12 for the 12 months. The total amount that Johnny will have to pay is 1200. Is it clear? In which Johnny will get the free handset and Johnny will get the free services. The market value of this handset is 300 and the market value of this handset is services is 960. That is 80 per month. So when we add these two values and take the proportionate value, we got 24% weightage in 1260 for the handset, and the remaining 76% is the weightage of the service. Okay, so in this 1200, 24% is actually the value of the goods that should have to be recognized, and 76% should be the value of the service. So when we take 1200 into 24%, we got the amount of 288. So in the bundle transaction, actually the value of the handset is 300, but because of the bundle transaction, we have sold the handset and the service at the same time at a discounted price. So the discounted price of this handset is 288, and the discounted price of this service is 1200 into 0.76. We got the value of 912. So this is how we have calculated the value of the goods and services. So if you have some confusion, you can ask it immediately. 24, okay, 24 is actually the weighted average amount. That is 960 plus 300, the amount will be 1260. And the weightage of the handset is 300. So 300 upon 1260, we got the percentage of, is it 300 divided by 1260 into 1200? Yes, very right. So 300 upon 1260 is 24%. And multiplying this with the 1200, we got the final amount. Why we take the percentage? If it's fine totally. If you don't want to take the percentage, it's fine. So does it mean that the ABC has to recognize only 288 at the time of the sale? Yes, ABC should have to recognize when the control of the handset is passed to the customer. Then ABC should have to recognize 288 initially as a revenue, and the amount of the service will be recognized over period. Is the handset is a variable consideration? No, handset is not a variable consideration. I'll give you the example of variable consideration. The meaning of the variable consideration is a little bit different. So you can see here that this is how the calculation of this value has taken place. So 1260, 300 plus 960, 1260, the weightage of this is approximately 23.8. I have taken the round off figure, and it is 76.2%. So I have calculated it as 288 because of the rounding difference, and it's 912. So because of the rounding off, there is a difference of 2 or 3 rupees, which is totally fine because it's immaterial. So let's read the answer of this part. Please try to concentrate. Under new rule of IFRS 15. Okay, sorry. Identify the contract as step 1, which is obvious here as there is a clear 12 months plan with the Johnny. So the 12 months plan with the Johnny shows that the step 1 is achieved and step 1 is done. The second is identify the performance, all the performance obligation. From this contract, we can, with Johnny, step 2 in a 5-step model, the obligation to deliver the handset, and there is an obligation to deliver the service over 1 year. So identify the contract is the step 1. Identify the performance obligations in a contract is the step 2. So we have identified that we have to deliver the handset and the services of the network. Now step 3, identify the transaction price. Is 1200 calculated a monthly? 100 into 12. Now ABC needs to allocate that transaction price. Now we are going to allocate the transaction price 1200 to the individual performance obligation under the contract based on the relative standalone selling price. This is a very important point that you should have to memorize, that for the allocation of the transaction price, you have to take first the standalone selling price of both the components and taking the relative percentage and applying that percentage to the final transaction price so that you can get the value of the goods and services separately. Then step 5 is recognize the revenue when ABC satisfies the performance obligation. When ABC gives the handset to the Johnny, it needs to recognize the revenue. When ABC provides network service to the Johnny, it needs to recognize the total revenue of 914. It's practical to do so once per month as the billing happens. So this is how you can plan your answer, and this is how you can formulate your answer, and this is actually the requirement. First, you have to show and justify your answer according to the provisions of the standard. Then you have to show some calculations. So this is how we can present our answer in the examination. Okay, there are a few questions from the student side. Since the service without the handset is 80 and the Johnny is paying 100, can we say that the handset price is 20? No. We cannot say that the handset price is 20. How do we recognize the unrecorded revenue? Is it deferred? Can we recognize the total 914 at once as the period is below 12 months? Can we recognize total 914 at once? No, you cannot recognize 914 at once because 914 is the value of the 12-month service. So yes, at the end of the 12 months, you can recognize the amount of the service, but it's not at the initial level. So if you want to see more detailed explanation of this question, you have to move on towards the next slide. So these are the accounting entries that we should have to use. When ABC gives the handset, Johnny, it needs to recognize the revenue of 285.60 immediately. So the sale of the handset 285.6 or approximately 288. We have to debit the financial position, that is unbilled revenue. It's actually a receivable account. So receivable account will be debited, but it's still unbilled. Therefore, we cannot use the receivable from Johnny. And revenue credited when the handset is given to the Johnny. Then secondly, on the monthly basis, there will be a proportionate revenue of this 100 million that should have to be recognized. So receivables from the Johnny should be debited at the end of the month. Receivables from the Johnny should be debited by 100, and revenue from the service should be recognized for a particular month, because 914 is the value of the revenue for 12 months. So for the first month, it will be 76.2. So revenue will be credited. You have to receivable debit. And finally, the unbilled revenue should be credited. So this amount should be cancelled with this unbilled revenue. So the remaining amount will be deferred in the next period. And when we receive finally the cash from the journey, the accounting entry should be cash debit and receivables credit. So these are the accounting entries. Can we recognize the total? No, we don't. So a very simple accounting entries. Here is treatment of deferred income. Actually, there is no deferred income in this question. Deferred income will be used when we receive the amount in advance actually. And you can see here that the Johnny is paying the whole amount on a monthly basis or at the end of each month. So there is no concept of deferred income here. Are we recognized on a monthly basis? Yes. But the sale of the handset is recognized immediately when we have transferred the handset, and the remaining amount will be recognized for the service on a monthly basis. Now, here is another question for you. An entity negotiates with the airline, major airline, to purchase the tickets at the reduced rates. It agrees to buy a specific number of tickets and must pay even if unable to resell them. Okay. The entity then sets the price of these tickets of its own customer and receives the cash immediately on purchase. The entity also assists the customer in solving complaints and with the service provided by the airlines. However, each airline is responsible for fulfilling the obligation associated with the ticket, including remedies to the customer for dissatisfaction with the service. So, the step one is to identify the contract with the customer. So, when the customer has purchased the ticket from the airline, it means step one is done. Then identify the performance obligation in the contract. This is tricky. Is it to arrange for another party provided a flight ticket, or is it to provide the flight ticket themselves? We'll look at the risk involved. If the flight is cancelled, the airlines pay to reimburse. If the ticket does not get sold, the entity loses out. Look at the reward. The entity can set its own price and thus rewards. On the balance sheet, therefore, the entity takes most of the risk and rewards here and thus they control the ticket. Thus, we have the obligation to provide the right to fly the tickets. Then we have determine the transaction price. This is set by the entity. Allocate the transaction price to the performance obligation. The price is here is the gross amount of the ticket price they sell it for. Recognize the revenue when the entity certifies the performance obligation. Recognize the revenue once the flight has occurred. So you only have to book the revenue when the flight take off actually with the passengers. Because if the flight got cancelled, you have to pay the amount back to the. So for all the airline businesses, they always book the revenue when the flight is actually started, and actually when they say that when the flight is gone in the air, then you can recognize the revenue. So it's very important that you should understand this point, that revenue can only be recognized then when we have delivered the when we have delivered the service. There's a question that, there are some questions. If we receive the whole amount, can we recognize the service as a whole on 1 year? If you receive the whole amount in advance, initially you have to recognize it as a deferred income. Then on the monthly basis, you can book the revenue. Will we lose any marks if we make mistakes in allocating the transaction price? Definitely you will lose some marks if you have done some mistake in the calculation. What if the customer does not pitch to fly? Yes, it's up to the customer if the customer don't want it to fly, but we are only responsible for the time when the flight has fly. So if the flight is gone, then it means the company can recognize the revenue. So here is another question for you. It's my recommendation to please try to understand this question. I'm giving you just 1 minute to please read this question and try to solve it by yourself. And if you have any confusion in this question, you can ask. Please read the question and try to solve it. Yes. Please check your emails that whether you have received a mock exam on your emails from ACCA. please write yes in the chat box if you have received the mock exams in your email. Please check the emails, and if you haven't received yet, please inform us. Okay, that's fine. Please do attempt this mock exam before Saturday, and in the Saturday morning we will be discussing, I will be sending you the answers of this mock, so you are required to attempt this mock by tomorrow so that we can discuss the mock on Saturday, and we'll try to utilize 1 more hour for the remaining standard. Okay, now if you have any question in this slide, please do ask it immediately. If you have any question in this part. What time for the class for the Saturday? Same time. Explain 10900. Okay. Actually, for the sales of 100,000 to the customers, we have received 10,000 points. So our responsibility is to sell the goods and to redeem the points, because each point is redeemable for $1 discount on any future purchases. So customer actually will get the discount in the future purchases. So we are selling actually 2 things to the customer. The one is the goods, and the second one is the right to get the discount. And the value of this right is actually 9,500. So what we have done, we have calculated, as you know that we have to calculate we have to allocate the price on the standalone price of each contract. So the value of the goods is actually 100,000, and the value of these points is 9,500. So the total amount is 109,500, and we have to take the pro rata or weighted average, so that we got the value of the product, that is 91,324. That should be recognized immediately when we have transferred the amount, and the point will be dependent upon the customers who redeem the points. So when the customer is going to redeem the point, then we can recognize the revenue relating to the points, because you can say that if we are offering this type of discounts and if you are offering this type of points scheme, the customer, the sales value will go up. So actually the price of the goods is 91,000 and the price of the points is 8676. Okay, the customer expect to redeem the points. So is it not an expense for the firm? Yeah, we have to recognize the corresponding expense in the future when the customer has availed the discount. But right now we have to book the revenue for the points. Actually we are charging the 100,000 amount and we are giving the points for the free. So what we are doing, we are allocating the price between the goods and the points. Okay, it's a past paper time. So the next part is Tang entered into a contract with the customer to sell an existing printing machine such that the control of the printing machine vests with the customer in 2 years' time. So the key point is that we are not transferring the control right now. And you all know that for the goods, you can only recognize the revenue when the control is being transferred to the customer. The contract has two payment options. The customer can pay 2,40,000 when the contract is signed, or 300,000 in 2 years' time. When the customer gains control of the printing machine, the interest rate implicit in the contract is 11.8% in order to adjust for the risk involved in the delay in the payments. However, the Tang's incremental borrowing rate is 5%. The customer paid 2,40,000 on 1st December when the contract was signed. So the customer has paid 2,40,000 when the contract was initially in the first signed, and the key point is that at the start or at the inception of the contract, we have not yet delivered the contract. We have not yet delivered the control of the machine to the customer. So what should be the accounting treatment? What should be the accounting treatment according to IFRS 15? The debit should be the cash component. The cash should be debited. $240,000, and credited should be contract deferred income, that is liability. Contract liability, 240,000. I think I should have to delete first. Debit should be cash by 240,000. The first point is. Credit should be contract liability. It should be 240,000. But IFRS 5 says that till the time you have delivered the amount to the customer, you have delivered the machine to the customer, you have to book the financing component. And this transaction should be considered like you have taken a loan from a third party. So for annual basis, you have to book the interest cost. So interest expense should be debited and contract liability should be credited with the amount that we should have to charge. The rate should be the incremental borrowing rate. This is again the requirement of IFRS 15 to book the liability at the incremental borrowing rate. So it should be like this, that we have taken the loan from the customer until the time we have delivered the machine. We have to book further interest cost. So the annual interest cost of 240,000 is 12,000 at the end of year 1. For year 2, it should be interest expense debit and contract liability credit, and we have to charge the interest on the cumulative amount. That will be 240,000 plus 12,000 into 0.05. The amount will be 12,600. And then finally, when we sold ultimately the goods to tank company, the accounting entry should be contract liability should be debited and revenue should be credited. Because we have not yet paid the amount, so the interest for the second year should be based on the total of 2,40,000 plus this contract liability of 12,000, because we have not yet paid any amount to the tank company. So the tank company should have to book interest on 2,52,000. So you can take the percentage of 5% at 2,52,000, you get the value of 12,600. And by the time when we have delivered the goods, the accounting entry should be contract liability debit and revenue credit. So this transaction actually involves some financing component. Therefore, we have booked the liability initially and then interest on the annual basis till the time we have delivered the printer. But if we have selected the second option, that was payments in 2 years time, and the goods will be delivered to the customer immediately, and the control of the printer will be transferred to the customer immediately, and we have to pay the amount after 2 years, then we should have to calculate the present value of the future cash flows. So at that time, it should be recorded at the present value of the future cash flows. Like suppose I'm giving you the question that if I have entered in the contract to sell a car, we have entered in the contract to sell the car with the value of 600,000. The customer will pay immediately 400,000. Then the customer should have to pay 200,000 after 1 year and 300,000 in the second year. So the whole amount that the customer should have to pay will be 9 lakh. Because I'm giving the credit facility to the customer, or for simplicity, it should be, okay, I'm removing this amount. I'm giving you the question, please do attempt this question, that right now we are selling the car with the value of 600,000 and the customer have to pay some amount after 2 years. That is, right now the customer is required to pay only 300,000 and after 2 years he should have to pay 500,000. So in totality, the customer should have to pay 800,000 to buy a car. Discount rate is 10%. And the control is transferred. The control is transferred to the customer immediately. So what should be the accounting entry that we should have to make now and after 1 year? So please try to solve this question, that I'm selling the car to the customer who should have to pay 300,000 immediately and remaining 500,000 after 2 years. Please write down the accounting entry. What should be the accounting entry? Yes, we take 500,000 discounted by 10%. That's very true. Okay. Okay, there is a question from the previous question that at what amount should the revenue be recognized? 2,40,000 plus 12,000 plus 12,600. Yes, the revenue should be recognized with 2,64,600. When we calculate the present value in the case the customer pays in 2 years time, do we use the rate 11.8%? Yes, when the customer have to pay the amount after 2 years, then we have to use the rate that is 11.8%. But if the customer has paid the amount in advance, you have to take the rate of incremental borrowing rate. Receivables 800. 713 will be recorded as revenue at the of sale. The recognized 600,000 is revenue and the interest would be charged and would be revenue. So what should be the answer for this question? By 1.1012. After 2 years, customers have to pay 413,250. So the accounting entry at the start of the period should be receivables debit, cash debit. Receivables should be debited by 300,000. The cash should be debited by 413,250. And the remaining amount will be recognized in sales. 713,250. This should be the accounting entry at the inception or at the time when we have transferred the control of the car. How did you get the figures? Like you can see here that I have said this before that 300,000 is the amount that we have received immediately. So 300,000 is the down payment and the 500,000 we have to pay in the next 2 years time. So what I did is to take the present value of the future cash flows. So after 2 years, the 500,000 will have to be paid and I take the present value of this 500,000. We got the value of 413,250. So by adding these two, the revenue for the sale of the car should be 713,250 right now. And subsequently, you have to debit the receivables and credit the finance income gradually, which should be the 10% of 413,250. So for the first year, it should be 413,250 as finance income. It means that we are selling the customers the car and the related facility, credit facility, and we are booking the finance income for the credit facility, and we have booked the sale of the car at this value. What percentage did you use? I have given the rate of 10% actually. So I have used the rate of 10%, and actually I've done some round of. No, finance income is not a deferred income. Deferred income is actually the advance unearned income that we have received. Double entry for the finance income. It's very simple. Receivable debit, finance income credit. Haven't you made a double entry with the 41325 approximately? Why we need to do the double entry for the finance income? I have just make the double entry for your understanding, because we have to report the receivables. The receivables is now 413,250 plus finance income of 413,250 from the customers. And we have to recognize two types of revenue in the income statement, that is 713,250 for the sale of the car, and for the credit facility we are charging the finance income. So actually we have sold two types of things to the customer. One is the goods, that is the sale of the car, and other one is the credit facility, that one is the service. So when the time period of the service has passed, we have to book the revenue for the service. In which year the finance income will be recognized? Financial income will be recognized at each reporting date. So we are assuming that this entry should be made at the start of the period, and we have to recognize the finance income at the end of the first year. Then at the end of the second year, we have to book the further finance income based on the cumulative values of the receivables. How do we calculate the finance income? This is just the percentage. Actually, we have calculated and take the present value by taking 10% rate. So we have to take 10% for this receivable figure. So the receivable is actually the discounted figure. You have to take the 10% value, which will be considered as the finance income. Why the finance income credit? Why is the finance income credit? All the revenues and all the income should have to be recorded on the credit side. This is actually the basic concept of accounting, I think. Any other question from the student side? At what rate did you calculate the 413250? 413250 is calculated at 10% rate. I have built my own question. I have given the values. I think some of the people are using the values of tank company. This data has nothing to do with the tank company. The tank company is the question for the past paper. I have just gave you the question which I have prepared right now here on the slide. The rate is 10%. You can calculate the value at 10%. 1 divided by 1.10 first, second. So the discount factor for the second year is 0.826. Multiply by 500,000. We got the value of 413250. So it is actually calculated at 10%. So we are moving towards the next slide. Yes, here is another question for you. So it's my request for all of you to please try to attempt this question immediately by yourself. I'm giving you just 1 minute I'm giving you just 1 minute break. This is my break actually. It's not your break. So all of you are required to solve this question in 1 minute. Okay, shall we start or you need some time? I need some space to solve this question. Wait. Shall we start? Okay. Let's start. Tang enters into the contract on 1st December 2014 to construct the printing machine on the customer's premises for a promised consideration of 1500,000. So the revenue in the contract is 1500,000 with a bonus of 100,000. Now this is called actually the variable consideration. Like most of the people wanted to know about what is variable consideration. So here we have a variable consideration. If the machine is completed within 24 months, okay. Again, Tang enters in the contract on 1st December 2014 to construct a printing machine on the customer premises for the promised consideration of 1500,000 with the bonus of 100,000 if the machine is completed within 24 months. So if we have completed the machine within 24 months before the time, then the customer will pay us further 100,000, which is our revenue actually. So this is called variable consideration, which is attached to the specific situation. So sometimes it will not be probable that we will not be able to complete the machine within 24 months. So we cannot include the amount in the revenue. Because if it is not possible to complete the machine in 24 months, so there is no need to include the amount in the revenue. At the inception of the contract, TAN correctly accounts for the promised bundle of the goods and services as a single performance obligation according with IFRS 15. At the inception of the contract, Tang expect the cost to be 800,000. So the cost of the contract is 800,000 and the profit in the contract is 700,000. And we'll conclude that it is highly probable that the significant reversal in the amount of the cumulative revenue will occur. Okay. So it is highly probable that the significant reversal in the amount of the cumulative revenue will occur. So there is a high chances if you include the bonus. If you include the bonus in the revenue, you have to reverse the amount in the future. So whether it should be included in the revenue or not, what is your answer? The bonus should be included in the revenue or not? It should not be. Yes, very fine. It should not be included in the revenue. So we have to ignore this 100,000. Okay, mainly issue is to supply the components. Tang's influence, okay. Again, completion of the printing machine is highly susceptible to the factors outside the Tang's influence. So it is not possible for the Tang to complete the machine in 24 months. At 31st November 2015, Tang has satisfied 65% of its performance obligation on the basis of the cost incurred to date. So in the income statement, Tang should have to charge the revenue and the cost and the profit on 65% basis. So 65% basis of the cost incurred to date concludes that the variable consideration is still constrained in accordance with IFRS 15. Okay. So on the basis, we have earned 65% of the contract. So 800,000 into 0.65, we got the value of 5,20,000. For the profits, we have earned 45,500. No, it should be 4,55,000. And from the revenue perspective, we have earned 9,75,000. So it's 9,75,000. Okay. However, on 1st December 2015, the contract is modified with the result that the fixed consideration and expected cost increased by 1,10,000 and 60,000. So now the total revenue, this is actually the figures for the total revenue. So the total revenue has increased by 1,10,000, means it's now 16,10,000. And the total cost is now 60,000 more than the previous cost, that is 5,80,000. The time allowable for the achieving the bonus is extended by 6 months, with the result that the TAN conclude that it is highly probable that the bonus will be achieved and that the contract will still remain the single performance obligation. Now, it is highly probable that the bonus will be achieved. Now, whether the revenue relating to the bonus should now be included in the contract or not, whether we should have to include the bonus now in the contract or not. Sorry, the cost of the contract, it is now, it has increased from 800,000 to 860. So you're very right. It's not 580. It has increased from 800,000 to 8,60,000. Sorry for the mistake. Okay. Now what IFRS 15 says about this variable consideration? IFRS 15 says that unless it is probable that you will receive the amount of the revenue, you cannot include the amount in the revenue. So now it is highly probable that you can receive the bonus in the future. So now you can adjust your revenue by further 100,000. So actually your overall revenue is now 17,10,000 minus 8,60,000. So now the profit for this contract is now 8,50,000. So from 150,000, your profit has increased because of the bonus factor. Then the time allowed for achieving the bonus extended for the 6 months, and highly probable that the bonus will be achieved. The TAN has the accounting year end is 30th November. So till 30th November, we have achieved actually 65% of the contract. So further 65% of the contract, so we have to book further contract based on the revised cost. So we have to calculate the new percentage of the percentage completion. So we have incurred 5,20,000 out of 8,60,000. So the percentage should be now 8,60,000. It is now 61%, 60.5 approximately. So you have to adjust your revenues and the cost and the profits according to 60.5%. So now From the revenue side, we can book the further revenue, that is 1710 into 60.605. There will be a revenue of 103455. But we have already charged in the income statement, that is 9,75,000. So we only have to adjust, because of this adjustment, the additional amount of the revenue. I've done some mistake. 1,034,550 minus 975,000. There will be an additional 59,550. This is the amount that we should have to recognize. So for this type of question, you will be very lucky that examiner will ask you the calculation part of the question rather than theoretical. So for 6 marks, you have to write some of the provisions of IFRS 15 about the variable consideration. Then you have to justify your answer according to the provision of IFRS 15, whatever you are going to write in the question. And then finally you have to do some short calculation like this, and you will get the answer. Now the question is how we have calculated 60%, 60.5%. The 60.5% is actually the revised calculation, because the percentage according to 800,000, previously our cost is 800,000. So the 65% of the cost means that we have incurred already 5,20,000. And as you can see in the scenario, that the company is using the basis of the cost for the calculation of the percentage. So 5,20,000 out of 800,000 means 65% of the cost is incurred, means 65% of the contract has done. But the cost has now increased to 8,60,000. So we have done 5,20,000 of the work, 5,20,000, 5,20,000 out of 8,60,000. So by dividing these values, 5,20,000 upon 8,60,000, you get the value of the revised percentage. Because of the changes in the variable considerations and increase in the cost factor and revenue factor, you have to recalculate the percentage, and your percentage is now 60.5. So you have to adjust your total profits and the revenues according to the revised percentage. Second year, no data. No, you do not need to worry about second year, because examiner has asked about the calculation till 30th November 2015. So actually, according to the IS 10, we are adjusting the transaction. So it's an adjusting event actually. Is the variable consideration the same as the contingent consideration? You can say this, that the variable consideration is contingent upon some future event. So yes, you can say that a variable consideration is just like a contingent consideration. How much complete? It is 60.5% completed. So when we apply the 60.5% on the revised revenue figure, the final revenue that we have already earned according to the revised percentages, 10,34,550. And as you know that we have already charged 9,75,000. So we have to book the incremental revenue portion. So we have recognized the incremental amount, that is 59,550. Okay. Is it done? Any other question? Any question from this slide? But the reporting year is 30th November. Yeah, the reporting date is 30th November. It is actually the application of IS-10, that is an adjusting event which should be adjusted because the financial statement has not yet finalized. So the year end is 30th November, and we come to know about some adjustments. So it is actually an adjusting event according to IS-10. Therefore, we have adjusted the revenues and the profits. So it is, do remember this point, that this is standard, is one of the key or important standard for December session. So try to understand these concepts and try to do 2 to 3 questions from the exam kit from this relating to IFRS 15. So it is one of the favorite standard of examiner. So do you people know that what are the favorite standards of the examiner? What are the favorite standards of the examiner? So I'm telling you, the favorite standards of examiner that has nothing to do with ACCA. It is actually just my opinion. So it's not any official statement that I'm giving to you. It is, in my opinion, the favorite standards of from the examiner's point of view is IAS 8, then we have IAS 16, 21. Please note down the sequence. The sequence is very useful and important for you. 24, 20, 36, 37, 38. One of the most favorite, 38. Then we have IFRS 3, one of the favorite standard of the examiner. IFRS 5, one of the favorite standard. IFRS 9, one of the favorite. 13, 15, and now IFRS 16. So these are the most important standard from my perspective for this paper. So try to memorize at least the key provisions of these standards at least. And I will provide you on my WhatsApp group the summaries of all these standards so that you will be having the sound knowledge. And I think a few standards like IS 8, 16, 21, 24, 36, 37, 38, these all are basic standards, and most of the standards that you are most of the standards that you are already started in paper F7. So I think the summary is important, but it's my recommendation, just read the summary of a particular standard and then try to attempt at least 2 to 3 adjustments for that standard. Then you will feel some sort of confidence how to attempt the question. But remember this point, you have to write some provisions before solving the calculation. Then IFRS 3, 5, 9, 13, 15, 16, and almost we have done some of the key areas of, I have almost touched all the standards, almost, I think. Today we are doing IFRS 15 and 13, And tomorrow we'll be doing IFRS 16 and IFRS 9. So this is my target for tomorrow, that is Friday. On Friday, we'll be doing these two standards, IFRS 9 and IFRS 16. And because IFRS 9 is a little bit longer than other standards, therefore we have to utilize our Saturday as well for IFRS 9. Like hedging component will be discussed on Saturday. Okay, IFRS 16 is so hard. Will you teach? Yes, definitely. I'll teach IFRS 9. It's so simple, I think. We will discuss the matters of IFRS 9 tomorrow, so don't you worry about IFRS 9. What about the new development for the question number 4? Don't you worry about the new development of question number 4. I will update you. I need some time to do some research work. So I will give you on the WhatsApp group. I will give you some key important articles relating to the new developments. So right now you have to focus on the consolidation, and please do focus on the standards. Mostly examiner asks questions relating to the current issues, so don't worry about the current issues. I will tell you a few topics about the current issue at the end. But first of all, you should have a very sound grip on these standards. The second priority of the examiner is IES 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The second priority standards is IES 12, I think, IES 19, IES 20, 23, IES 40, 41. So these are the second priority standards of the examiner. Then we have IFRS 10 and 11. So if you wanted to score good marks, just prepare and try to memorize the key concepts of these standards. IFRS 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Okay. So these are, I think, it's my opinion personal, that these are the first priority standards of the examiner, and these are the second priority standards of the examiner. And for the consolidation, examiner always prefer acquisition and disposal rather than cash flow and foreign currency. The major preference of the examiner is the contract amendment an adjusting or non-adjusting event? It's an adjusting event actually, because if it is a non-adjusting event, it should be disclosed in notes. So it is actually, it provides a further evidence of the condition existing at the reporting date. Therefore, it is an adjusting event according to IS 10. So let's move on towards the next slide. Now what about the contract cost? So IFRS 15 provides some basis about the contract's cost. The basis is the incremental cost of obtaining a contract must be recognized as an asset. So if you have incurred some cost to obtain a contract, then it should be capitalized. But the key point is that if the entity expects to recover those costs, so what we do, we have to amortize this cost over the period. However, those incremental costs are limited to the cost that the entity would not have to incur if the contract had not been successfully obtained, like success fee paid to the agents. A practical expedient is available, allowing the incremental cost of obtaining a contract to be expensed if the associated amortization period would be 12 months or less. But if you have incurred some cost which will be amortized within the 12 months or the less than 12 months, then the whole amount will be recognized as an expense rather than asset. But if the cost of obtaining a contract will give you the benefit of more than one accounting period, or the contract life is more than accounting period, then first you have to recognize it as an asset, then it should be charged as an expense. Cost incurred to fulfill the contract are recognized as an asset. Cost incurred to fulfill a contract. It is again an important point. Your cost incurred to fulfill a contract are recognized as an asset if and only if all of the following criteria are met. The cost directly related to the contract. Number one, the cost generate or enhance the resources of the entity. And the final one is the costs are expected to be recovered. So if you are going to get the benefit from the cost that you are incurring for a particular project, then you have to recognize first this as an asset, then it will be amortized over the time period. This includes direct labor, direct material, and allocation of the overheads related directly to the contract. The asset recognized in expected in respect of the cost to obtain or fulfill a contract is amortized. That is very important. On a systematic basis that is consistent with the pattern of the transfer of the goods and services to which the asset relates. So these are some of the provisions for the contract cost. You can capitalize the contract cost if it will give you the benefits in the future, and the cost is specifically related to the contract, and it is highly probable that the cost will be recovered. So here is the last question for you before the break. We'll be taking a break. There is a demand from the student side that we should have to take a break first, but I'm giving you just final one question. So please solve this last question, then we will take a break. So please try to read this question and plan your answer, then we will discuss after 1 minute. If you paid the recruitment fee for the 10 staff for contract during the contract period to design, what will be the treatment? If we paid the recruitment fee we are paying to whom? To whom we are paying the recruitment fee? To recruit for the contract hiring. Okay, two staff has resigned, but the contracting company should have to provide you the further 2 staff. So if your 2 staff has resigned, then either you will receive your money back or the company will arrange for the 2 employees. So you have to recognize that cost as an asset if it will give you the benefit of more than one accounting period. Will we amortize the cost of fulfilling the contract or the cost to perform the contract? Both the cost to acquire the contract and the cost to perform the contract, both should be recognized as an asset, and then it will be amortized if it will give you the benefit of more than one accounting period. That is the most important requirement. So please try to read this question, then we'll start solving. Okay, let's start. Kherson constructs retail vehicle outlets and enter into contract with the customers to construct the building on their land. Okay. The contract has standard terms, which includes penalties payable by the garrison if the contract is delayed. So you have to pay some penalties. Or payable by the customer if the garrison cannot gain access to the construction site. Due to the poor weather, one of the project was delayed. As a result, garrison faced additional cost. One of the project was delayed as additional cost and contractual penalties. So you can easily understand that this cost should not be included in the asset, because the cost of fulfilling the contract cost should be recognized as an asset only when it is recoverable and when it will give you the future economic benefits. So this is actually the additional cost and the contractual penalties that should have to be charged as an expense. As the garrison could not gain access to the construction site, the director decided to make the counterclaim against the customer for the penalties and additional cost of the garrison faced. So garrison felt that because of the claim had been made against the customer, the additional cost and the penalties should not be included in the contract cost, but shown as a contingent liability. So actually it is the cost that we have beared, then we have to book this as an expense. Garrison has assessed that the legal basis of the claim and feel that it is enforceable rights. In the year ended 30th December 2007, February 2007, Garrison incurred general administration expense cost of 10 million. Now, you cannot capitalize general administration cost according to IFRS 15, but if it is specifically incurred for a particular contract, general administration cost, and it will be recovered in the future, then you can capitalize this asset. And the cost related to the wastage of the material of 5 million. This is again the amount that should have to be charged as an expense. Additionally, during the year, the garrison agreed to construct the storage facility on the same customer land for 7 million at a cost of 5 million. Now, here you can see that there is an other contract. So this is not actually related to the previous contract. There is a new contract which should have to be dealt with separately. So you cannot mix the above two contracts because we have a separate contract to construct the storage facility. The parties agreed to modify the contract to include the construction of the storage facility, which has been completed during the current financial year. All of the additional costs relating to the above were capitalized as an asset in the financial statement. So this is the very important point. So company has capitalized all the amount, and you have to justify that this amount should have to be written down as an expense, and also this amount should also be recognized as an expense. The director of the garrison wishes to know how to account for the penalties. Counterclaim, penalty should be write off as an expense. Counterclaims, additional cost in accordance with the IFRS 15. So just by writing off the simple provisions of IFRS 15 and justifying the amount and clearly stating that this amount should be recognized as an expense, so you can see see that the 15 million that we have incurred should be recognized as an expense. But the cost agreed to construct the storage facility in the same customer's land for 7 million at a cost of 5 million. So this contract has not yet started, but when we start this contract, the cost of fulfilling the contract, if the criteria is met, then it should be capitalized. But if the criteria are not met, then it should be recognized as an expense. So this is the overall answer. You have to discuss and justify your answer. 15 million will be expensive. because the 15 million is the amount that cannot be capitalized. Because for the capitalization there must be three criteria which should have to be met. And the general administration expense and the wastage material, these are cannot be capitalized. What about the counterclaim? Okay. The director decided to make a counterclaim against the customer for the penalties and additional cost which the garrison face. So the counterclaim that we are expecting should not be included in the revenue because of the fact that there is no probability about the future economic benefits, and we don't have any statistics about the counterclaim that whether the counterclaim will be successful or not. So we cannot recognize counterclaim as an asset. So let's take a break of 5 minutes. We will start the next session after 5 minutes. Okay, welcome back. If you have any questions and confusion about this question, you can ask it immediately. Okay, by making a counterclaim, does that not mean that the penalty cost will be recovered and so has to be capitalized? Uh, Actually, we can only capitalize the cost that which should have to be recovered and will give you the benefit of more than one accounting period. So penalty cost is not something that will give you the benefit in more than one accounting period. So it is actually a loss that you have to incur. Secondly, talking about the counterclaim, should not be recognized and included in the revenue, because the counterclaim, there is no probability about the counterclaim and the information about the counterclaim that whether we are going to receive the amount or not. But if it is probable that we will receive the counterclaim amount, then it could be included in the revenue. Can you briefly repeat the treatment of the costs? Which cost you are talking about? What is the ruling on general and admin expense? The general and administration expense should have to be charged as an expense, but the key point here is that if the general expense is incurred specifically for a particular contract, then it can be capitalized if it is giving you the benefit of more than one accounting period. Okay. So in the previous example, we have few costs, the penalties. Although penalties can be recoverable, but it cannot be capitalized. It should be recognized when it is incurred and charged as an expense. Then second, we have the counterclaim. If the chances that you will receive the counterclaim in the future, then you can add the counterclaim in the revenue. Administration expense should be charged as an expense, but if the question is specifically mentioning you that the administration expense is specifically for a particular contract, that can be capitalized. Usually administration expense will be charged as an expense. And wasted material. Wasted material is not actually incurred on the contract, so it cannot even be capitalized because it will not going to be recovered. Then Garrison agreed to construct a storage facility. We have another contract that should have to be considered separately, and it can be included as a modification, but it will not affect the previous contract because we have a separate performance obligation for this contract. As a legal enforceable right, that does not mean that there is a probability of receiving the claims. As a legal enforceable right, yes, but you have to see the facts and figures, and you have to see the terms of the contract. We haven't given the detailed information about the counterclaims. We only have the single line that the garrison could not gain access to the construction site. The director decided to make the counterclaim for the customer for the penalties and additional costs which the garrison faced. Garrison felt that because the claim had been made against the customer, the additional cost and the penalty should not be included in the contract cost, but shown as a contingent liability. So rather than showing it as a contingent liability, it should be recognized as an expense and included in the cost when it was incurred. For the counterclaim, as we do not have the detailed information about the counterclaim, but if it is probable that we will receive the amount in the future, then we can include this amount in the revenue. So what should be the approach to deal with the questions like this? It is highly recommended for all of you to please, when we do a particular question in here, then you are required to write the answer of this question by yourself and then check your answer from the standard past papers answer and check that whether you will be able to produce 70 to 80% of the answer of the examiner. So it's not possible for you, and it's not required that you should produce 70 or 100% answer from the examiner standard. But if you will be able to apply the standards and its application properly with some provisions, then you will be able to get 100% marks in the exam. So it's very useful and important for you to please write the answer of the question which we have solved in here, and then all of you are required to attempt to match your answer with the examiner's standard, so that we will find your mistakes and you will find it will improve actually your confidence. So moving on towards the next slide. Now we have IFRS 15 for the fair value measurement. IFRS 13 is not applicable on these standards like IFRS 2, IS 2, IS 17 has been obsoleted, and IS 36. Then IFRS 13 does not mandate when the fair value measurement should be used. It is already given in a particular standard. So whenever you see the term fair value for a particular standard, we always have to refer IFRS 3 except IS 2, IFRS 2, and IS 36. Then we have the definition of the fair value. The fair value is actually the price that would be received to sell an asset. Like if you are going to sell my car in the market, then what price that I will receive, that is called the replacement cost, will be considered as a fair value, or paid to transfer a liability in an orderly transaction between the market participants at the measurement date. This is sometimes referred to as exit price. So the price that we will be received to sell the asset or to settle a liability, this price is also called exit price, and it should be an orderly transaction between the market participants. Market participants means that it should not be the related party. Like it is possible that I sold my car with a value of 1 million to my brother for 400,000. So 400,000 is not the market value of my car, because we are not the market participants. So the individuals should be independent and market participants. So now moving towards the next slide. Yes. For determining the fair value, first of all, you have to identify an asset or a liability. Like you have identified a car or a provision under IS 37. Identify the assets or liabilities, maybe a standalone asset or a liability. It might be a single asset or a liability. It might be a group of assets or a group of liabilities. A group of assets and liabilities. Group of assets and liabilities means we are talking about the net assets actually. That we are going to buy a company for which we have to purchase the shares. So we value the business through its net book values. Through its net assets value. The level at which the fair value is measured may depend upon the level at which the asset or liability is aggregated or recognized. So we have been given some basic information about this. IFRS 13, sorry. Then moving towards the next slide. An entity should take into account the characteristics of the asset or liability if the market participants would take those characteristics into account when pricing the asset or liability. Such characteristics include the condition and the location of the asset, the restriction, if any, on the sale or usage of the asset. An entity should take into account the characteristics of the asset or a liability if the market participants would take those characteristics into account. Like, for example, if you have a car of a Toyota, like we are taking the product of Toyota, like one of the products is Toyota Corolla. Like if you take the Toyota Corolla example, and we are going to buy the Corolla of 2015 or 2016, that is a used car. So the price of the car will depend upon the condition and the location of the asset. Like in some places, the value or the price of the car is higher than some places which we have the lower prices. So IFRS 13 wanted to say that the prices should not be manipulated on the basis of the conditions and the location. Like you can see in the market that the Corolla with 2016 for the year 2016 can be purchased at the price of 1,500,000 rupees in Pakistan, or 1,800,000 or 1,700,000, depends upon the condition and the location of the asset. And the restriction, if any, on sale or usage of the asset. For example, if I have purchased a car on the lease terms from the bank, so there will be a restriction from the bank side that you cannot sell the asset unless you have paid the full amount to the bank, because the legal title of the asset rests with the bank. So you cannot purchase or sell the car to someone else unless you got the prior permission with the bank. So these are the factors that you should have to consider before measuring the fair value. So the actual guidelines have not yet started. Yes, this is the most important, one of the most important point. Which is my important point? Yes, this is. The fair value measurement assumes that the transaction takes place either in the principal market or the most advantageous market. So you have to take the fair value measurement based on the principal market or the most advantageous market. Principal market and most advantageous market. The principal market is the market with the greatest volume or the level of activity of that asset or liability. Where we have a large number of buyers and the sellers of that market, then you can identify. For example, like for shares, if you have some shares with you for a particular company, so the principal market for that share will be the stock market, because we have got a lot of buyers and sellers for this market. So the principal market will be considered as a stock market. But if the principal market is not existed, then we can say that some lower market, we can approach some lower market. We have few suppliers than the principal market. So that is called the most advantageous market. Is the market in which the entity could achieve the most beneficial price. So you might see that there are some shares in which the company which is not registered on the stock exchange. So you can find some marketplace where you can buy or sell the shares other than the stock market. Then it will be considered as the most advantageous market. Like for a car, if you have got the main market for the car where the lots of buyers and sellers can interact with each other, then this is called the most principal market. But if you have few buyers and sellers and they do not have a proper market for the transactions, then you can use the most advantageous market. So the price, when you are calculating the price, you have to take the prices of the principal and the most advantageous market, because there can be some manipulation in the prices on the fact that the company can take the prices of one of transactions or there might be some abnormal transactions in the city or in the country, or you can take the example of some abnormal transaction. Like it might be possible that one of my car with a value of 1500,000 I've sold to someone who liked the color of my car, who liked the features of my car, who purchased it at a value of more than 1500,000. And if I'm in a financial difficulty, it is possible that because of the liquidity issues, I have sold my car with a value of 1500,000 for just 1100,000. So this is not actually the fair value of all the goods and services in that market. The fair value can be calculated through the principal market and the most advantageous market. So let's move on towards the next slide. An entity measure the fair value of an asset or liability using the assumption that the market participant would use when pricing the asset or liability. Market participants are independent to each other and knowledgeable about the asset or liability, is able to willing to enter into the transaction for the asset or liability. Just this is just a basic slide. It is not that important. Yes, this one is the most important point from IFRS 13. For a non-financial asset, non-financial asset means the land or building or property or something like that. It takes into account a market participant's ability to generate economic benefit by using the asset in its highest and the best value. If you remember that we have already discussed this point in the previous cases, that whenever you are going to calculate the fair value of a non-financial asset means other than shares and other than financial instruments, which are assets. So the assets other than the financial assets can be calculated, the fair value should be calculated on the basis of the highest and the best use. So what is the best use of that asset? If you have two options, either you can use the car, you can sell the car immediately, or either you can use the car for rental purpose. So the best value will be the highest value. It is like in under IAS 36 that you know that recoverable amount is the higher of net selling price and the value in use. So if you have more than one use of the asset, then you have to take the most valuable use in which you got the highest value. The highest and the best use takes into account the use of the asset that is physically possible, legally permissible, and financially feasible. So the change, the use that you want it for a non-financial asset should be physically possible, legally permissible, and it should be financially feasible. So moving towards the next slide. The fair value of the measurement of a liability or an entity's own equity instrument is based on the assumption, this is again a very important point, that the liability or the equity instrument is transferred to the market participant and would remain outstanding. If a transfer value, not an extinguishment or settlement. It is a transfer value, not an extinguishment or settlement. It means that you are not settling the shares actually. You are just transferring the shares from one party to another party. Similarly, for the liability, you have to assume that the liability is being transferred from one party to another party. Yes, this is again one of the most important slide for IFRS 13 that is the fair value hierarchy that we should have to use for the valuation, for the fair valuation measurement. So for calculation of the fair value, you have to use input level 1, input level 2, or input level 3. The highest priority is given to the quoted prices. Like you wanted to know about the prices of a particular share, then you can just open the website of the stock market and check if the company is listed company, then you will get the prices, that is the quoted active market prices for identical assets or liabilities. So if you have a proper market of that asset, of identical assets. Then you can check the prices. So input level 1 is usually used for the shares, but for non-financial asset like cars and other thing, you cannot use, I think, the input level 1 for the property because we don't have any market or quoted price for the properties. But for the new cars, you can use the prices, and you can check the prices through the website. Like if you wanted to know the price of the Toyota Corolla car or Suzuki car or the car of a Honda company, you can just check the website and you will get the quoted price of that car, but the price will be for new cars. But if your car is slightly used, then you will not get the quoted price of that car. So IFRS 13 says that if it is not possible to calculate through input level 1, then you can move on towards the input level 2. Input level 2 means you have to use the observable input, means market related data not including the level 1, quoted price of a similar asset or liability, and you have to take the observable input from the market and you have to adjust the price according to your price. Like if I have got the shares of a company which is not listed in a stock exchange and I want to know the fair value of my shares, then you cannot use input level 1, you have to use input level 2. And for that input level 2, you have to see that which share in the stock exchange is nearest to my shares or compatible with my shares or having with the same industry, same characteristics, same features, same size of the business. So you have to take the share price of the similar shares on the stock market and adjust the price according to your price. This function is called input level 2. But even input level 1 and 2 is not possible, then you have to follow input level 3, in which we use non-observable input, means we have to take some data other than the market data. So like entities own data, in which we use normally the valuation techniques. That is one of the techniques is the present value of the future cash flows. If you wanted to know the value of something, you can calculate the present value of future cash flows, or you can use the cost-based approach or income approach. So these are some basic techniques. I think you have already started business valuation topic in F9. So in business valuation concept, mostly we are using input level 3 for the calculation of the market value of the business, fair value of the business. So there is a question from the student side. If an entity has not yet received the permission to use the land for an alternative purpose, that is best use. Is the best use can be the entity use the value of the that the value of the best use when it believes that there is a high chance of the government granting the permission. Yes, if there is a chance that the government give you the permission, then you can use the prices for the valuation of the best use. But if it is not legally permissible or physically possible, then you cannot, or you think that it's not financially feasible, then you cannot change this. So the two slides are very important. First is for non-financial assets, what are the requirements, and the second one is the input level hierarchy. Yes, these are the basic definitions of observable inputs, that is market related data, and non-observable inputs. Yes, these are the techniques that we use for input level 3, which could be in the market approach. Use prices generated by the market transaction. This approach is used for input level 1 and 2, but income approach and the cost approach can be used for input level 3. For the highest best use, the need for them to meet the criteria. 3 criteria or either one. Yes, it's important to meet all the 3 criteria. Like if the thing is not legally allowed, then how can you do the best value? How can you calculate the best value? Or if it is not physically possible to do something, like if we purchase the land on the moon, then I think it's more profitable. But if it is physically possible to move to the land, to moon, so it should be physically possible, it should be financially feasible, and it should be legally permissible. So all the criteria should have to be met. Then these are just the disclosure requirements, and it's not examinable at all. You just only need to read to. Yes, here is a question for you. So my requirements for all of you to please read the question. We have 10 more minutes left. We can attempt 2 questions. So I'm giving you just 1 minute to please just read the question so that we can solve it immediately. Okay, so let's start. Mehran, a public limited company, has just acquired a company which comprises of farming and a mining business. Mehran wishes to advise on how to fair value some of the assets acquired. One such asset is a piece of land which is currently used for the farming. One such an asset is a piece of land. The fair value of the land if they're used for the farming is 5 million. So right now The fair value of the land for farming purpose is 5 million. If the land is used for the farming purpose, a tax credit currently arises annually, which is based on the lower of the 15% of the market value of the land, of 500,000 at the current market tax rate. The current tax rate in the jurisdiction is 20%. So first of all, we have to calculate the value that we will receive if we use the land for the farming purpose. So the value is a tax credit currently arises annually, which is based upon the lower of the 15%. Lower of the 15% of the fair value. So 5 million into 15% will be 7,50,000. So the lower value is 500,000. So you will get the tax credit of 500,000 into 0.2. There will be a tax credit of 100,000. So that will be 0.1 million. So the final value will be 5.1. So how we have calculated the 1? Because the tax rate is 20 million and we'll receive the tax credit on this 500,000. So the 20% of this 500,000 will be 0.1. So the benefit we will get from the land if we use for the farming purpose is 5.1. Okay. Mehran has determined that the market participant would consider that the land could have an alternative use for the residential purpose. Now you can use the land for the residential purpose as well. The fair value of the land as the result before the associated cost is to be 7.4 million. So 7.4 million is the land before associated cost that we have to incur to convert the land from farming to the residential purpose. In order to transform the land from the farming to the residential use, that there would be a legal cost. It should have to be deducted because we have to calculate the net value. A viability analysis cost of 0.3, that should also be deducted from here. And the cost of demolition of the farming land, farm building will be 100,000, 0.1. So we have to deduct all these values. Additionally, permission from the residential use has not been formally given by the legal authority. Because of this, the market participant has indicated that the fair value of the land after the above costs would be discounted by 20%. So we have to take the 80% value for this. So by deducting 7.4 minus 0.2 minus 0.3, 7.4 minus 0.2 minus 0.3 minus 0.1, we got the value of 6.8 million. So 6.8 million is the value, and we have to take 80% of 6.4. The value will be 5.44. So if we use the land for the residential purpose, there will be a 5.44 value, and if we use the land for the farming purpose, there will be 5.1. So the highest and the best use value is 5.44. In addition, so for this land, Mehran should have to value this land for 5.44. Secondly, in addition, the Mehran has acquired the brand name associated with the product produced from the farm. Mehran has decided to discontinue the brand on the assumption that it will gain increased revenue from its own brand. Mehran has determined that if it ceases to use the brand, then the indirect benefit will be 20 million. If continues to use the brand, then the direct benefit will be 17 million. So it's not like it's not the use or the other use of the brand, because the brand can only be used for a particular reason. So we have only one value for this brand. It's not like this that we have two uses of the brand. One use is we got the value of it, because if it ceases to use the brand, so it's about the cessation of the brand. So this will not be the message of IFRS 13. So for the best and highest use, we can only take the value of 17 million. So 17 million is the value of the brand at which should have to be reported. So any question from you? We have not take 80% of the 7.4 and then deduct the cost. Why we have not take the, okay. After the above cost, it's clearly mentioned here that the margin have indicated that the fair value of the land after the above cost would be 20% discounted. So first of all, you have to deduct all the costs, and you take the discount of 20%, or it could be you can take directly 80%. Why 20 million is not reported? Basically, IFRS 13 says that for taking the fair value, you have to take the best and the highest value for the use of that asset. So if we are using the brand for one purpose and if you are using the brand for another purpose, we have to take the highest value. But for this 20 million is the value if we ignore, if you forgot, if we cease to trade the use the brand. So if we are ceasing to trade the brand, work with the brand, it means that we are not using the brand. So the highest value is just 17 million, and if we not use the brand, it will give you the benefit of 20 million. But the 20 million is not associated with the brand actually. It is the benefit you will get by not using the brand. So IFRS 13 says that you have to take the value for the best use of that asset. Okay. So here we have completed one past paper question. Because of some time limitation, we will not be able to cover the whole part, but I'm giving you the assignment. This part is your assignment. Please try to attempt this part of the question. We have two questions for you. One is this one and the second one is the last one. So I have attempted the part A of the question. You are required to attempt part B and C of the question. That's your home assignment. So for today, the home assignment is to repeat the key provisions of both the standards and to do the practice question of these standards. So tomorrow we'll be doing IFRS 16 and some of the concepts of financial instruments. Thank you very much. Take care. Allah Hafiz.